Hello everybody and welcome back to today's video. We have an absolutely spit the coffee out hilarious type article headline from the Financial Times that is trying to blame short sellers' historic 2025 losses on you and me, the retail investor. Before we unpack how bogus that claim is and get to the mind-blowing number of dollar losses that short sellers have accumulated this year, I wanted to first say this is not financial advice. Anything said in this video is strictly opinion content, and you should always consult a licensed financial advisor before making any decision to invest. Quickly, if you are unfamiliar with what a short seller is, essentially it's a person or firm or institution that borrows shares of any equity, any stock, and then sells them expecting and hoping that the price of that stock comes down and then they can buy the shares back at a lower dollar amount. Now, the trade can go belly up quickly if they borrow their shares. Let's say the company's currently trading at $10 and that company's stock goes up to 20, 30, 40, 50. That is unlimited loss for the said short seller. The stock, if it keeps appreciating, they're short, they can never buy it back. They'll have to buy it back with the stocks already up 50, 60, 70, 80, hundreds of percent in some case. So it is extremely risky to do this. And the overarching thing here too that I wanted to say before we get into some mind-blowing stats in this article is that betting against companies is typically saw as sort of a predatory mark in the markets. And it's not that you can't do it or that it's illegal. It's perfectly within the rules and legal. It's just that by nature, you are betting against American, in most cases, businesses. And in and of itself, to quote Ryan Cohen of GameStop, that is un-American. But to each their own. If that's how you make your living, more power to you. However, it would be probably a rough year, as it says here, a basket of 250 U.S. stocks, most popular with the short sellers, have surged 60% this year, absolutely demolishing shorts. And this is coming to us from S3 Partners. So when the basket of short stocks goes up, short sellers lose infinite gains. And this is actually really interesting. It's the most negative gains for short sellers since 2020 when that same basket gained 85%. So we are not even done with the year as of recording this video. So we'll see if we get a big fall and kind of Christmas-ish rally if the Fed keeps cutting rates. This might be the year that shorts are completely wiped out. And of course, I say that half jokingly, but it's definitely possible as we're already seeing big names leaving the short market for good. We'll get to two big ones in a minute, but I did want to cover the fact that the companies they cite in this article are definitely eyebrow raising. We have Bitcoin miner TerraWolf here, and then the rental car company Hertz. Obviously, if you've ever traveled, you know what Hertz is in your lifetime. But both have more than 40% of their shares on loan. So shorts are currently stuck with significant losses on both of those companies. They're going to have to buy them back if those companies are able to rebound. Typically, short sellers look for companies with declining revenue or a declining sector that they're basketed into, and then they will short those equities. Now, in the event that those companies or sectors turn things around unpredictably in some cases or otherwise predictably in others, the shorts are very at risk of going belly up. And when we think about why would short sellers short in this environment, well, in fairness, in April, with all of the negative mainstream media headlines about tariffs and the Trump administration not knowing what they're doing and this, that, and the other, kind of the Black Monday market crash type scenario, well, everything pulled back significantly, the S&P 500 included. So a lot of the short positions at that time were probably big time in the money and profitable. But to truly be profitable, you have to take profits, meaning you have to cut the trade at a certain point. But apparently they did not, and they got greedy. So here you go. Here's the graphic. This is from the Financial Times. The red chart is the most shorted stocks, and you can just see they are going parabolic upwards. And you can see that the dip here. This was a very minor dip, all things considered, compared to the upside in April when they were at the tariff lows. And look at the average U.S. equities. they're just chugging along. Typical, buy and hold, never sell type philosophy. They're chugging along. Meanwhile, the most shorted stocks are going absolutely bananas. So this is kind of funny, though. The other part of this, which I find extremely ironic, and let me know in the comments if you guys do too, is the fact that they are blaming us, the retail investor, you and I, who our trades sometimes don't even see the light of day. But don't take it from me. Take it from Barron's, one of the most official sources of the stock market. Owned by News Corp, their headline reads, "Dark pools are handling more stock trades. Wall Street is fighting back." Okay, what is a dark pool? Well, a dark pool is essentially an off-exchange area where stocks are bought and sold. What does a dark pool do? Well, it does not affect the price of a stock. You can trade in the dark pool by hundreds of shares, millions of shares. It will not affect the price. It has to trade on lit exchange, which is not the dark pool, for price to be impacted. So how could retail be influencing the market and be causing short sellers to lose so much? The exact statistic says that on-exchange trading fell below 50% for the first time ever at the end of 2024. So I am really failing to see how retail could be influencing any of this. The other interesting thing is here, it clearly says that market makers are the ones that provide liquidity to the actual on-exchange markets. It is not retail. If you're thinking, oh, I'm a Robinhood customer, I'm going to buy and sell stocks and this and that, you're actually trading through Citadel, which we could make a whole nother video on, but it's a PFOF system, which is a payment for order flow system. Citadel pays Robinhood to execute the customer's trades. Citadel is the one making the market. They are the one matching the buy and sell orders. They're doing all of it. You just have pretend shares, I hate to be so insensitive, on your Robinhood account. And that's not a shot at Robinhood. Credit to them for making this a very profitable business model. But let's take a look at Robinhood and short sellers and how much they've actually lost on that particular stock and others in this year. This is pretty nuts when you think about the amount of dollars being lost here by shorts, but a couple estimates here, $73 billion, according to S3, again, same data provider as a Financial Times article, in the first part of 2025. And that was before it really plunged by a broad market rally. A 4% rise in the S&P caused $73 billion in losses. Well, since early April, the S&P 500 is up upwards of 36, 37%. How much more losses do you think than that? Probably a lot more than 73 billion. But specifically on stocks like Nvidia, $250 billion in short selling losses from Nvidia and Tesla, maybe the Mag 7 too. That's a lot of money. We're going to be almost at $1 trillion here. SMCI, another tech chip company, $2.2 billion in short selling losses. I'm sure that's on the conservative side. And then going back to Robinhood, a company that I think has mixed reviews at this point. I think that's being fair. $3.5 billion as of mid-October. So Robinhood is now trading in the hundreds of dollars a share. It was once all the way back down in the teens. Short sellers have been absolutely clobbered, and that's the problem. When you go for it all as a short seller and you borrow shares at $20 thinking you can short the stock back down to $10 and it goes up parabolic past $100, you have infinite losses, so much so that a couple shorts had to shut down and close up shop. This quote from a short selling firm is pretty rich here. "It's been really, really hard this year," said Ann Stevenson Yang, who co-founded activist short sellers and long research shop J Capital Research. What a trendy name that is. Ever since 2020, we've all been waiting for the market to become more rational, and it hasn't. It's gone up, 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 and up. And the fact of the matter is, and yes, we can get to a couple other short sellers like Nate Anderson and Jim Chanos packing up shop for good. But if you think about this too, the sectors in general and the mainstream media influence over these headlines, like tariff being doomsday 101 for the market, is directly contributing to this. So this is from a New York Times article that was published in early April of 2025, saying trade wars set off max pessimism in global markets as stocks plunge. The S&P fell 5%, its worst deep drop since June of 2020. And then, of course, they're going to slander the Trump administration for tariffs and for trading fears. And this was published on April 2 and updated on April 3. And I just find the authors interesting here. You have a reporter from Tokyo and a reporter from London, and they're talking about the U.S. market commentary. Very interesting. I'm sure no conflict of interest there, but you had numerous mainstream media publications saying, oh, Trump trade war. And if you just zoom out and forget what your thoughts are on the Trump administration, or you're left-leaning or right-leaning, or who gives a rip, if you just think about Trump is a businessman, his whole career has been deal-making. You have the mainstream media, you have short sellers, they're all piling in on this super fear-based market conditions, when in reality, if you think about Trump, what does he do? He makes deals. What did he do shortly thereafter all of these fears? One, he paused some of the tariffs, which really threw shorts into a total death spiral for their positions. And then two, he started to negotiate actual trade deals. These are concrete trade deals that started coming out. The first was with the UK. They made a deal. Vietnam made a deal. And you can see the new tariff rate is coming down. Indonesia made a deal. The Philippines made a deal. Japan has a deal. The whole EU in late July of 2025 made a deal. And then South Korea. So you're going to see more of these. If I were a betting person, I would say that. I am not a betting man, but I certainly would think that as a deal maker, that's what you're going to get. So short sellers, to put a bow on this, blaming retail is not only super questionable when you look at the mechanics of the market, which don't even really trade a majority on lit exchange anymore. They're all off to the dark pools. Secondly, you have the mainstream media fear propagating, hoping that retail sells their positions to people like Jim Chanos and Nate Anderson and all these short sellers who are now packed up and long gone. But ultimately, you have this fear-based narrative where shorts are being absolutely clobbered, hundreds of billions of dollars, potentially more. I think it's hilarious. But the last thing I want to say about it is the last person they should be thinking or blaming is retail. The retail investor is simply trying to at least have their savings or their retirement money, or hey, maybe even make a little bit on the side of their regular 9-to-5 job. All they're trying to do is have some success in the markets. Short sellers are pretty much the ethos directly against that. Again, however you make your money, that's fine, but leave retail's name out of it.